If you're saving for retirement, you've probably asked the question, should I go Roth or traditional? Both accounts help you grow your money tax deferred, but the choice you make now could be worth tens, even hundreds of thousands of dollars in retirement. Luckily, with recent legislation that passed, we are no longer facing the potential for increased taxes, but it's still an important decision to make nonetheless. Choosing the wrong account year after year can end up costing you thousands in taxes over the long run. That loss of savings could delay retirement, cause you to spend your assets down more quickly, or force you into higher tax brackets at inopportune times. But before we dive into all that, my name's Ryan Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm that helps clients nationwide make smart money decisions that go beyond just investing. Let's get started. Let's first start with what the difference is between both accounts. With a traditional IRA, your contributions may be tax deductible, growth will be tax deferred, withdrawals will be taxed as ordinary income, and you are going to be subject to RMDs at age 73. And for those of you who were born after 1960, you'll be subject to RMDs at age 75. With the Roth IRA, contributions are made with after-tax dollars. Growth is still tax-free, and qualified withdrawals will be tax-free as well as long as you follow the rules. There's also no required minimum distributions during your lifetime. And the trade-off is simple. Do you want the tax break now or later? But that question becomes harder to answer when tax laws and your income are in flux. So what's at the heart of this traditional versus Roth debate? Well, it's will your tax rate in retirement be higher or lower than it is today? And here's how you should think about it. If your tax rate now is lower than it will be later, Roth would make a ton of sense. If your tax rate now is higher than it will be later, traditional might be better, but it's also hard to forecast that out. But let's go over a brief example that illustrates why these two rules make sense and why I want you to think about them within the context of your own retirement plan. There are three ways your tax picture will change over your lifetime. They will either increase, decrease, or remain level. But here's the funny thing. If taxes remain level, it doesn't matter which type of account you choose. If you put $100,000 into Roth over time and were always in the 24% tax bracket, you would have paid taxes before those contributions of about $31,500 over the years. And let's say that you earn an 8% return a year on that $100,000 over 10 years. The balance would have grown to about $216,000 that you can take completely tax-free. Now, if you made traditional contributions, you would have contributed the $100,000 plus that $31,500 that you paid in taxes on the Roth, but because you didn't pay them on the traditional, you were able to include those in your contributions. If you earn the same rate of return, which is 8% over a 10-year period of time, your $131,000 would grow to about $284,000. But then when you withdraw it and you pay the 24% tax, you'll pay $68,000 in taxes, which would leave you with the same $216,000 that you would have in the Roth example. And there's a little bit more nuance behind it than that, but you guys are getting the point that I'm trying to illustrate here. But as soon as you were to move from the 24% bracket to the 22% bracket, choosing traditional would have saved you $6,000 in this example. But if you go from the 24% bracket to the 32% bracket, Roth would have saved you about $23,000 in this example. And as you start adding more zeros and bigger balances to the base of what you're contributing, the cost of a mistake magnifies. So as long as you have a good inclination as to which way your taxes will go, you can optimize around a contribution type. But that's much easier said than done. Some general rules that I like to follow are as followed. Earlier in your career, you're likely to be in lower tax brackets. You'd probably want to consider Roth in this scenario. If you have income sufficient to max out your 401k, traditional could work in your favor because you're likely in higher brackets due to a higher income. If you're set to inherit IRAs from someone, consider traditional contributions to offset income in years you have to take funds from the inherited IRAs. Finally, if you're in one of the top three tax brackets while working, traditional typically makes more sense. Now, these aren't steadfast rules, but they typically work out in your favor most of the time when you follow them. Now we're going to talk about one major drawback of traditional IRAs when it comes to the time in which you are in retirement. Traditional IRAs come with one major catch. At age 73 or 75, if you're born in 1960 or later, the IRS requires you to start withdrawing a minimum amount from your IRA each year, whether you need that money or not, and it's called a required minimum distribution or RMD. And those RMDs are taxable, and they can push you into higher tax brackets, make more of your Social Security taxable, and trigger higher Medicare premiums. Roth IRAs, on the other hand, there's no required minimum distributions during your lifetime, period. You get control over when and if you withdraw money. And that makes Roth not just a tax strategy, but a planning flexibility tool. There are, however, still great reasons to choose a traditional IRA, and you might prefer traditional if you're in a very high tax bracket today and expect to be in a much lower one in retirement. You need the upfront tax deduction to qualify for other credits or benefits. You're close to retirement and plan to convert to Roth later during your low income years. And you're contributing to a non-deductible IRA and plan to use the backdoor Roth strategy. Just be sure to avoid the pro rata rule in this instance. But don't forget, every dollar in your traditional IRA comes with a future tax bill attached. But if you're in the 12, 22, or 24% tax brackets today, the Roth may offer exceptional value because you're locking in today's low tax rates, you're protecting your future withdrawals from tax uncertainty, you're avoiding the RMD trap, and you're creating tax-free income that won't impact Medicare or Social Security taxation down the line. Plus, Roth conversions are an amazing legacy planning tool. Your heirs can stretch distributions over 10 years and pay zero tax on that growth. That's huge if you're looking to build generational wealth and thinking about your family beyond just yourself. If you already have money in a traditional IRA, you don't have to start over. You can convert existing balances to Roth. You'll pay taxes on the converted amount now, but you'll avoid higher taxes in the future. You can reduce your future required minimum distributions, and you build a tax-free bucket you can access later on your terms. Just be careful not to push yourself into higher tax brackets or trigger Medicare premium surcharges known as IRMA. A multi-year Roth conversion plan usually works best in avoiding those. And if you're someone who is contemplating Roth conversions on money you never plan on using, you need to consider your beneficiary's tax situation and compare it to yours. For someone who wants to leave money to their kids or corporate executives, doctors, lawyers, or other high-earning professionals, utilizing Roth conversions makes a ton of sense, because if those kids inherit traditional dollars, they will likely be bumped into higher tax brackets, making more of your hard-earned dollars taxed. However, if your beneficiaries choose less lucrative careers and are in lower tax brackets, accelerating conversions at higher tax rates than they would otherwise pay would be very foolish. When it comes to making your decision, I want to leave you with a quick checklist. Are you in a low to moderate income tax bracket now, like the 12, 22, or 24% bracket? If you are, you might want to consider Roth. Do you expect higher taxes in retirement? Roth wins again. Do you need the deduction now to reduce your AGI to qualify for other benefits and credits? Traditional might help. Do you want flexibility and control later in life? Roth would give you that. Do you want to avoid required minimum distributions and legacy tax issues? Roth would be your friend in this instance. It's not about picking one account and ignoring the other. The best approach often combines both traditional and Roth accounts for tax diversification. This lets you control your tax bracket in retirement by choosing which bucket to withdraw from year to year. And the great thing here is you're not locked into one decision forever. If you receive stock options that push you into higher brackets one year, but not the other, and you can switch then between the Roth and traditional depending on your income in a given year. Nothing is binding, and this needs to be reviewed annually to make sure you're making the optimal decision. The Roth versus traditional debate isn't new. Don't just default to what everyone else is saying. There are reasons and merits to both types of accounts. Make your decisions based on where the tax code is headed, not just where it's been, and specifically where you think you're going to fall within that tax code. If you want help building a tax-smart retirement strategy personalized to your situation, reach out to us here at NavWealth Partners. We're here to help turn today's decisions into tomorrow's peace of mind. Thanks so much for watching, and I'll see you in the next video.